Every single day, your retirement savings are being drained, and you probably don't even realize it. This silent thief doesn't make headlines, but it's quietly robbing your future wealth. And the worst part? Most people never catch it until it's too late. This isn't just about saving money. It's about protecting your freedom, your time, and the lifestyle you've worked hard for. If you ignore this hidden threat, you could end up working years, longer than you planned. But if you learn how to outsmart it now, you could retire sooner, live better, and finally take control of your financial future with less stress, less risk, and way more confidence. Part 1. The tax drag you don't see. Most investors do not realize it, but every year they delay using tax-advantaged accounts, their money is quietly bleeding away. It is called tax drag, and it is brutal. Whenever your investments earn dividends, interest, or grow in value, Uncle Sam wants his cut. And if you are holding these assets in regular taxable accounts, that cut happens every single year. It is like running a race with a heavy backpack. Every dividend taxed, every capital gain skimmed. Over decades, this silent loss compounds into a massive hit on your total wealth. But there is a solution. Shields like IRAs, Roth IRAs, and TFSAs. Inside these accounts, your investments can grow without the constant tax bleeding you would face elsewhere. You get to keep more of your growth, compounding your gains year after year. The kicker? Every year you delay contributing to these tax shelters, you are handing over more of your future wealth to taxes without even noticing. You miss out on an extra year of protection, an extra year of tax-free or tax-deferred growth. And the longer you wait, the bigger the penalty becomes. This is not about missing an opportunity. It is about actively losing money you could have kept. Shield your money early, and you will watch it grow stronger and faster than you ever imagined. And if you think 1 year does not make a difference, wait until you hear how procrastination can kill your future wealth permanently. Part 2. The penalty of procrastination. Every year you wait is a wealth killer. When it comes to investing, time is either your best friend or your biggest enemy. And the truth is brutal. Every single year you delay investing is a year you can never get back. Imagine two investors. One starts investing $5,000 a year at age 25. The other waits until age 35. Even if the second investor doubles their yearly contribution to catch up, they will likely still end up with less money by retirement. Why? Because compound growth is not linear, it is exponential. Time multiplies your money like nothing else. And when you invest in tax-advantaged accounts like IRAs or TFSAs, you are not just compounding your investments, you are compounding your tax-free growth. Delaying even 1 year does not just cost you the money you could have saved, it costs you the future growth of that money too. It is a double whammy. You miss the contribution and the exponential curve that would have launched from it. Waiting just 1 year could mean 6 figures less in retirement. Seriously, $100,000 plus gone, all because you hesitated. The penalty of procrastination is not visible today. It is invisible, silent, but years from now, you will feel it like a punch to the gut. And the saddest part? Many people think they have plenty of time, until it is way too late. But there is a way to flip the script. Want a tax strategy where you pay once and never again? Let's dive into it next. Part 3. The Roth Advantage. Pay taxes once, never again. Imagine this. You pay taxes on your income today. Invest that money, and then never pay taxes on it again. Not on the growth, not on the withdrawals. That is the power of a Roth IRA. With a Roth IRA, you contribute after-tax dollars. While you do not get a tax break now, your investments grow tax-free, and qualified withdrawals in retirement are also tax-free. This means all the earnings your investments make over the years can be withdrawn without owing a dime in taxes, provided certain conditions are met. This is particularly advantageous if you expect to be in a higher tax bracket in retirement. By paying taxes now at a lower rate, you avoid potentially higher taxes on your withdrawals later. Additionally, Roth IRAs have no required minimum distributions, RMDs, during the account holder's lifetime. This allows your money to continue growing tax-free for as long as you like, providing more flexibility in your retirement planning. In Canada, the equivalent is the Tax-Free Savings Account, TFSA, which also allows for tax-free growth and withdrawals, making it a powerful tool for retirement savings. But what if your employer offers to match your retirement contributions? That is free money on the table. Let's explore how missing out on these matches can impact your financial future. Part 4. Missed matches equals missed money. If your boss offers free money, take it. Here is a harsh truth. If you are not grabbing your employer's retirement match, you are literally turning down free money. And it is not just a few bucks. It can add up to hundreds of thousands over your career. Most companies that offer 401k or retirement plans will match your contributions up to a certain percentage. Maybe it is 3%, 5%, even more. Whatever it is free money, instantly doubling a portion of your savings. But here is where most people mess up. They do not contribute enough to get the full match. Maybe they think they cannot afford it. Maybe they are just not paying attention. Either way, every dollar they leave on the table is a dollar that could have been compounding for decades. Take this example. If you earn $50,000 a year and your company offers a 5% match, that is $2,500 a year you could be getting for free. Skip that match for just 1 year, and you are not just losing $2,500. You are losing decades of potential growth on that $2,500. Multiply that by 10, 20, 30 years. You are talking about 6 figures gone. And there is more. Some employers have vesting schedules, meaning you have to stick around for a few years to fully own the match. Leaving too soon could mean losing part of that free money, so always check the fine print. There is even a trap most people do not know about. If you contribute too much early in the year, you might miss out on matches that are spread across each paycheck. Not every employer trues up at year-end, so mistiming your contributions could cost you even more. Bottom line, if someone offers you a stack of cash every month, you would not say no. So, do not say no to your employer match. Max it out every single year. Think it is too late to catch up? Part 5. The power of catch-up contributions. If you are over 50 and feeling like you are behind on your retirement savings, good news. You are not out of the game. In fact, the IRS just handed you a second chance, and it is a powerful one. They are called catch-up contributions, and they allow you to supercharge your retirement accounts beyond the normal limits. For 2025, if you have a 401k, 403b, or most 457 plans, you can kick in an extra $7,500 on top of the regular $23,000 contribution limit. That means you could save up to $30,500 a year into your retirement plan. Plus, whatever your employer matches. Got an IRA or Roth IRA? You can add an extra $1,000 beyond the standard $7,000 limit. It might not sound like much, but stacked over several years, it can seriously close the gap between where you are and where you want to be. And the real kicker? These extra contributions grow with the same tax advantages, either tax-deferred or tax-free, depending on your account. That is more money growing faster, shielded from Uncle Sam all the way to your retirement day. If you are in Canada, you have a similar secret weapon. Unused RRSP and TFSA room rolls forward. So, if you have not maxed out in earlier years, You can catch up aggressively when you are ready. Bottom line, the system gives you a second shot, but only if you take it. Waiting until 60 or 65 to start piling in is too late. Start your catch-up contributions now and let compounding and tax advantages do the heavy lifting. Next up, it is time to level up even further by mastering tax diversification and putting yourself, not the IRS, in control of your retirement money. Part 6. Tax diversification. Retirement control. Don't put all your tax eggs in one basket. Most people think diversification is about mixing stocks and bonds. But when it comes to retirement, there is another kind of diversification that is just as critical. Tax diversification. Think of your retirement savings as being stored in 3 different buckets. Number 1. Tax-deferred accounts like 401(k)s and traditional IRAs. You get a tax break now, but pay taxes when you withdraw. Number 2. Tax-free accounts like Roth IRAs and TFSAs. You pay taxes up front, but withdrawals are tax-free. Number 3. Taxable accounts like brokerage accounts. You pay taxes on dividends, interest, and capital gains as you go. By spreading your savings across these buckets, you gain flexibility. In retirement, you can choose which bucket to draw from based on your tax situation that year. This strategy can help you manage your tax bracket, avoid unexpected tax hits, and even reduce the taxes on your Social Security benefits and Medicare premiums. For example, if you need extra cash in a year when your income is high, pulling from your Roth IRA won't increase your taxable income. On the other hand, in a low-income year, it might make sense to withdraw from your traditional IRA and pay taxes at a lower rate. Tax diversification also helps you prepare for future tax law changes. By having money in different types of accounts, you're not overly exposed to potential increases in tax rates. In Canada, similar principles apply. Balancing contributions between RRSPs, tax-deferred, and TFSAs, tax-free, can provide similar flexibility and control over your retirement income. Bottom line, tax diversification isn't just a strategy, it's a form of control. It gives you options, flexibility, and the ability to adapt to whatever the future holds. If you've made it this far, I've put together a powerful retirement defense guide, and it's completely free. Inside, you'll find simple strategies to protect your money from inflation, taxes, and other silent wealth killers, plus a checklist to help you stay on track every year. Just comment "retirement" on this video. Once we hit 50 comments, I'll drop the link for everyone to download. Now that you know about the silent tax draining your retirement, it's time to fight back with smarter investing. In the next video, I'll show you the dividend clock, a simple strategy to know exactly when to buy, hold, or walk away from dividend stocks. Timing is everything, and this could change your entire income game.